In our last video, we talked about doing goals for the new year. How much money can you make? How much is feasible? How much can you make for the new year? That's extremely important to know if the system is feasible, if it makes any sense or not. But it's not always about what you can make. It's also about what you get to keep. And that's what we're going to talk about risk. What is risk? Risk is the likelihood of you losing money. In anything that you do, any kind of business that you do, you're going to have a certain likelihood of losing money. And that is your risk. That is something that we are going to control. We have to control it. There are two types of losses. There's a stop loss and there's a real loss. A stop loss is a business expense. It's part of doing business. It's the same thing as any other business in the world. If you have a grocery store and you have produce and you have lettuce, you know that a certain amount of lettuce is going to wilt. A certain amount of lettuce you're going to have to throw away. A certain amount of eggs you're going to throw away. A certain amount of dairy you're going to throw away. It's just that kind of expense. A real loss, though, is debilitating and it's emotional. For example, you own a grocery store and the grocery store burnt down and you didn't have insurance and you lost everything you had. That is an emotional loss. That's a serious loss. You got sued. That is a serious loss. A large loss can ruin your account. It can be catastrophic. It can take you down to the point where you can't trade anymore. The biggest problem with most traders that I see are the catastrophic losses. Most traders don't have a problem making money. They can make $300, $500, $1,000 a day without any kind of problem. But then they'll take a $5,000 loss or $20,000 loss because they are not allowing themselves to look at losses as a business expense. They're not actually accepting the fact that they may take a stop loss. What happens with them is they become a deer in the headlights. How many times did it happen to you where you are in a trade and all of a sudden the stock starts running against you? And you think about, well, what am I going to do now? Well, where's my stop loss? Let me put on a different indicator. Let me look at the market itself. Well, I know I'm right about the trade. By the time you make all those decisions, the stock is already a buck against you. And then you have to make other decisions. Well, it's kind of stupid to take a stop loss right now. What if the stock bounces? What if I add in more into the stock? That type of decisions under stress, freezes you and you don't make any decisions and the stock is running against you. You're a deer in the headlights. The common problem is the emotional roller coaster that stops give you. If you take very large stops, they will put you on an emotional roller coaster that most people can't handle and they fall off. The worst thing you can do is to add into a stop loss. If the stock is running against you and you add more into it, you double the size of your trade in order to, okay, well, if it only comes back halfway, then I'll be break even. It'll be so much easier for me to be break even if I add into it. That absolutely spells disaster. Because you're teaching yourself the wrong habits. It takes a few times, yes, a few times you'll make money. A few times you'll make money because the stock will bounce, the stock will bounce, the stock will bounce. But one time when the stock does not bounce, one time when the stock keeps going against you, it can become an absolute disaster where you lose your whole account. We have to talk about the emotional load that you have per trade. Let's say, for example, you're starting a career as a trader, or you're questioning the fact that the trading can make money. You have the whole emotional load and you're testing yourself. You're testing the whole system. You're testing your whole career on every single trade. That question is in the back of your mind and you have that tremendous amount of emotional load on every trade. Instead of accepting the trade as a business expense, a stop loss as a business expense, as the trade itself as a transaction. Again, back to the grocery store. If you own a grocery store and you have a bunch of produce, you have a bunch of merchandise, every single one of them is equal to one trade. You can't take the whole store and put that on one trade. You can't go every time you sell a cucumber, go to your QuickBooks and see if you're profitable or not. The problem is doubt of success. The problem is that most people don't do the numbers. Most people don't do the homework. They don't look at a system. They don't look at the ratios. They don't look at the statistics of the system itself. And that's something I'm going to talk about in the next video. I'm going to talk about the statistics of trading. You have to be comfortable with taking a stop. Throwing away wilted lettuce is a part of doing business. Taking a stop loss, some trades do not work. That's a part of doing business. If you're 80% correct, or if you're 60% correct, if you're 70% correct, a certain percentage, 20 to 40% of the time, you're not going to make any money. You're going to lose money. You have to learn how to limit those losses and limit the emotional effect that they make on you. Sometimes taking a stop is actually good trading. Sometimes you're right about the trade, but you know what? You have to take the stop loss. And that is the correct trading decision at that point in time. Here's my definition of an exit. This is the only definition of an exit that I use. We always exit when the reason for entry no longer exists. If you bought a breakout, as soon as the stock is no longer in a breakout, you come out. If you bought a trend, an uptrend, as soon as the stock is no longer in an uptrend, you come out. And that means if it's a stop loss or if it's profit, it's the same thing. I'll show you some examples of that. The right stop. You have to pinpoint your entry. That means exact entry, to know exactly where you're going in, because that's how you can measure your actual risk. Exact entry points means that you know exactly when the trade is no longer working. If you're buying a breakout, that's your breakout level, that's exactly what you're buying. You know that if the stock pulls behind it, it's no longer working. We exit as soon as the reason for our entry no longer exists. Here's some example charts. ALGN, for example. Stock penetrated up here. That was our entry point. It went up. You can scale out. You can take some profits. As soon as it comes out, you want to exit. As soon as it comes back to break even, you want to exit. Why? Because you're saving yourself this trip back down. You are freeing up capital to be able to re-enter the stock when it comes back up. That is extremely important. Here's BTU. BTU penetrated, came back, stopped. That freed up your capital to re-enter. Now, if you picked your entry correctly, and if you know the profit potential of your trade, you know how far the trade is capable of going, you re-enter at $24.91 and it went down to the $16 level. A tremendous amount of profit without much risk, because you were able to pinpoint the entry. We found the exact support level, and that's what gave us the exact entry. Here's GA. GA is an interesting stock. It went up, penetrated, only by a couple cents, and then it kept going down. Now, if you were to add in, you were adding in, it's gapping against you, and over here you're sitting with a trade with a tremendous amount of loss without being able to do a whole lot with it. That is deer in the headlights. Here's Joey G. We were able to penetrate, we were able to find exactly the level of penetration, the exact entry point. That allowed us to take the trade all the way down. And it was in a downtrend, and only when it was out of a downtrend around this area did we exit. Down to the 15 level from the 22. That's 7 points on a $22 stock with exact entry point. That's why we're able to keep our very, very small, very, very tight stop losses. And that's why we're able to keep the kind of ratios that we keep. Here's an example of re-entry as well. Entry came down, nice profits, not bad, but then it came back up. So you scale out, you pay for your trade, you free up the capital, you look for the next trade. You were wrong about the market, you were wrong about the timing, whatever. It's okay to be wrong, and then you re-enter and you ride the stock down, which worked out extremely well for us. A good stop frees up capital for the next trade, which is extremely important. You want to be able to water your flowers, babysit your flowers, babysit your winners, babysit the stocks that are actually working for you, and pull the weeds. You do not want to babysit stocks. How many times have you been stuck in a stock that's going against you and you were not able to trade anything else because it was occupying 100% of your time? You want winners to occupy 100% of your time. Emotional stability. We can only take so many stops in a row before we lose our emotional stability. I limit my stops at 3. If I take more than 3 stops, I know there's something wrong and I walk away from it. Small stops are much easier to take. A $50 stop, a $100 stop is much easier to take than a $2,000 stop. A $50, $100 stop is actually a business expense. In our next video, I'm going to show you more about the right ratio, more about the statistics of good trading. What kind of edge do you have to maintain? What kind of profit? What kind of profit versus risk do you have to maintain? And so on. That's all going to go into the next video, so stay tuned.